Now, we understand that the real estate bubble, it is popping in Canada, Australia, Europe, even here in the United States. We see a lot of things breaking down, and we understand that China has already told their investors to pull their investments out of the U.S. and put it into the Belt and Road system. This is their new trade platform. And what we're seeing is that this is actually having an effect on real estate. Now, in the second quarter, sales of large office properties in Manhattan fell 26% from the same period a year ago. It was the worst second quarter dollar volume in years. And if we look at the graph, we can see that in the second quarter of 2016, sales hit about $8.9 billion. In the second quarter of 2018, sales hit about $2.9 billion. And we'll see why this is happening. Now, we need to remember back in time when Chinese investors were coming in and making these investments, they were buying these huge buildings, huge transactions. There was a $2.2 billion sale of a 245 Park Avenue to the HNA Group. That was the sixth largest transaction in Manhattan ever. The HNA paid $1,282 per square foot for the tower, which was called among the highest price per pound for this type of asset. It was the last big Chinese property purchase in Manhattan. This year, the first quarter was propped up by a $2.4 billion sale of Chelsea Market to Google. The deal accounted for over half the total transaction volume in the quarter. The price was a blistering $2,181 per square foot. But what brought the sales volume down in the second quarter was the absence of high-profile billion-dollar office deals. China wanted their investors to redirect their investing to the Belt and Road, and that's exactly what they did, and we're not seeing these same high-priced purchases. Now, without these foreign investors, without Google purchasing these multi-billion-dollar properties, what's going to happen? Well, things are going to start to deteriorate very, very quickly, and we're already seeing this happening. And on top of that, we know that a lot of these prices have been pushed up quite a bit. We're going to see all of that start to come down. Now, global debt has hit a record high of $247 trillion. And the IIF issues a warning with this huge amount of debt. Every quarter, the Institute of International Finance publishes a new number of the total amount of global debt outstanding. And every quarter, the result is the same, a new record high. But of course, today when they reported that information, there was no exception. According to the IIF's latest global debt monitor, the amount of debt held in the world rose by the biggest amount in 2 years during the first quarter of 2018, when it grew by $8 trillion to hit a new all-time high of about $247 trillion, up from $238 trillion as of December 31st, 2017, and up from $30 trillion from the end of 2016. In other words, there is now a $250 quadrillion in global debt, and it represents 318% of global GDP. More concerning is that this was the first time since the third quarter of 2016 that global debt to GDP increased, suggesting that the marginal utility of debt is once again below 1. This is how the debt is broken down as of the first quarter of 2018 and compared to the first quarter of 2013. Non-financial corporate debt. Well, 5 years ago, it was standing at $58 trillion. Today, it's $74 trillion. Government debt. Well, 5 years ago, it was $56 trillion. Today, it's at $67 trillion. Financial debt. 5 years ago, it was $56 trillion. Now it's $61 trillion. Household debt, 5 years ago, it was 40 trillion. Now it's 47 trillion. So we see that we're in a bit of a problem here with the debt load. Now, the government to debt GDP ratio has surged to 101% in the U.S. What was surprising about this report is not that, we hit these huge high debt numbers. Those are now standard. We just come to expect that. Is that the IIF voiced a strongly negative opinion of recent developments in the debt arena. Now, the IIF Managing Director Hung Tran said the pace is indeed a cause for concern. The problem with the pace and speed is if you borrow or if you lend very quickly, the quality of credit tends to suffer. It also means more governments, businesses, and individuals have been borrowing that could have trouble paying the money back or merely paying interest on it as rates rise. The quality of credit worthiness has declined sharply, Tran said. And Moody's has said the same thing at the end of May. And the IIF, they didn't stop there. They caution that with global growth losing steam and becoming increasingly divergent, and with the U.S. rates rising, worries about credit risk are starting to creep back to the forefront, including in many developed economies such as the United States, Western Europe. Government debt is higher than it was prior to the crisis, and corporate debt is higher as well. Now, think about this. The pace of debt, household debt, corporate debt, government debt, all this debt is rising very, very quickly. Wages, well, they're not moving up. So if wages aren't moving up, well, people aren't being taxed as much, right? The tax receipts headed into the government to pay this debt, not there. If wages aren't rising, it's very difficult to pay household debt. And if we're seeing inflation on top of this, the whole situation just gets much, much worse. Remember, the central banking system, this system is not designed to last this long. The central bankers, they know they have a certain period of time. The debt load, what they've done to the economy, it all deteriorates. Remember, they've been doing everything for themselves, making themselves very, very wealthy. And what they've been doing, they've been picking up hard assets. They don't care worthless about the paper money. Yes, they have the paper money, but they really care about the hard assets. Because when everything falls apart, the paper money goes to zero, they have the hard assets. Because they know they can always push the button and create more of this worthless paper money. So, what is the central bank doing right now? Well, we talked about how they decided to discontinue their Fred graph of their balance sheet normalization. We also understand that the corporate media is out there and they've been telling us that we're headed towards a recession. We also know that the Fed realizes that they can't keep the system going much longer. So what they do is they hide a lot of their data. Remember when they started quantitative easing, what did they do? They got rid of the M3 money supply. This way you can't see what was going on. And what they're doing right now is they're hiding some of their data or changing it. What they like to do, they like to change it so it looks like they didn't cause the problem. We had no indication that a recession was coming. And they also hid other data, and this is going back a little while, and we talked about this. This was the change in labor market condition index, and this was actually a pretty darn good indicator because it predicted recessions almost every single time. But they decided to discontinue this also. So what's very interesting is that we talked about the yield curve just the other day when the Fed was out there saying that the yield curve right now, it's not really a great indicator to tell us that we're heading into a recession. Really can't be used today because it really doesn't make any sense. It's, distorted, and they were using a lot of excuses. And it reminds me of the 1970s when they said gold speculators were in the market and this is why we need to come off the gold standard. So what the Fed did was they made this story up that the yield curve is no longer good. We can't use it. Nobody look at it. Everyone look away. The Fed decided to create a new yield curve. And this new yield curve does a much better job at predicting and showing us what's really going on in the economy. So let's look at this for a second here. What if your local weatherman forecasted weather not based on atmospheric conditions and other scientific data, but instead on his own forecast? I dream it will rain in 3 days, therefore my forecast is for rain in 3 days. His prediction method, if uncovered, would probably lead him to seek a new career. The weatherman's forecast is a good way to describe the new yield curve the Fed has recently publicized. This curve is calculated by comparing the current 3-month rate for treasuries versus what the rate is expected to be 6 quarters from now. And this is what the Fed expects it to be. The forward rate is calculated using the current rate and the interpolated rate on 1.5 and 1.7-year Treasury notes. In layman's terms, the curve is simply a forecast of what the market thinks the Fed will do. Now, this is crazy. Why did they do this? Well, let's look at this a little bit closer. The traditional 2-year, 10-year curve spread is falling at a decent pace and has been in a decline for the better part of the last 5 years. The new curve right now, well, it's doing something completely different. Now remember, the old curve is showing that we're declining. The new curve has been in a slight uptrend over the same period. Clearly, the curves now are sending different messages. The Fed has much more control over the shape of the new curve versus the traditional curve. The Fed has the ability to make this curve go any way it wants. They have full control over it. Think about what's happening here. They are removing data, hiding it. They are changing how they calculate things. And the question is, why now? Remember, the yield curve is showing us that we're heading towards a recession. Every time we see the yield curve invert, it's a great indicator letting us know that we're heading towards something really, really bad. Same thing with their other indicators, which have predicted recessions in the past. And they're all predicting a recession. Why change the yield curve now? Why make the case that it doesn't work in this new market? Well, it does work in this new market, in this new economy that they created. They just don't want anyone to see this. So what they're going to do is they're going to start putting out this new curve, and people are going to be looking at it going, oh, look, everything's fine. And the Fed is going to be out there saying, we're not predicting anything. And all the financial pundits and the mainstream media, they're all going to go along with this. And everyone else is going to be kept in the dark. Now, think about why they're doing this. The reason they're doing this is they're hiding everything that they're doing right now. They want nobody to know that they were the ones who brought this system down. They can say, we weren't predicting anything. We have no data on this. This must have been the tariffs. It must have been Trump's new economic policies. It must have been whatever they're going to say. And we have no other data. You see? Because what they do is they go back in time, they erase everything. They hide it. They don't want anyone to know. Remember quantitative easing with the M3? They just got rid of it. So nobody sees anything, nobody knows anything. Again, we don't audit their books, so we don't know what the Fed is actually doing. So we see right now that they've been exposed. They're hiding, removing, manipulating to cover up what is coming. And they know what's coming because they're about to do it. They know they can't keep the system going. And I said this for quite a while now, that both sides, the central bank system and Trump, and the patriots who are behind him, both sides are going to try to control the narrative. And the central bank is already making their move. They're already prepared and ready to control this narrative of when this whole system comes down. And the only way they can do it is hide everything that they've done. Because they know that everything they've done is basically manipulation. Manipulation of all the data, manipulated the banks, manipulated where all the funds have gone, manipulated pretty much everything. So as we can see, they are prepped and ready. They've been exposed. They're creating new data. And they're about to bring this whole system down. They're prepared and ready because they don't want to take the blame. The central bank wants to stay in control. They don't want to give it up. They like being in control. They need to create the currency of each and every government. This way they have control over those governments. And they're not just going to say, okay, we're out. We understand. We wrecked the economy. They will never admit to this. They will place blame on other areas. They'll say we had nothing to do with this. Please keep us on because we know how to manage an economy. And they're going to make all these different excuses, just like they did in the 70s, how there were gold speculators coming in, and this is why we have to come off the gold standard. This is why we have to be put onto the new system, which is the petrodollar system. They're going to do the same exact thing, and they're going to be pointing the finger, just like they did back then. They pointed at all the different countries who were speculating in gold and all this other stuff. Actually, they were asking for their gold back because they saw what was happening. The same thing's going to happen now. They're shaping the narrative to control what is about to happen. And it's playing out right in front of us. So no matter what, we're heading towards this transition. The thing is, who's going to control the narrative? Who's going to control the system coming down? And I think very soon we're going to see the Trump administration, the Patriots, start to pivot on what they're doing with the economy. And there might even start to be calls to audit the Fed. And I believe this might be happening sooner than later.